Hey, everybody. If you're in a situation where you have seen interest rates shift and you've said, wait a minute, I was making 5+% in my savings account, and then it was drifting down towards the fours and the threes, and you've seen that shifting over time, then you've already noticed what I want to talk to folks about. Now, the thing is, I want to go over a little bit of history here of what's going on, and then talk a little bit about what we anticipate or where we see things headed. Now, this is something that I absolutely love. It's a chart. Not everybody likes these though. But this is showing you the federal funds effective rate. And when you look, if you notice back in August of 2016, we had a really low rate. Something that President Trump was saying before his first term in office was that interest rates had been kept too low for too long. And that's true because there was nowhere really to go in the event of an emergency. So you notice they were raising rates. Well, what happened? We ran into COVID. COVID knocked things off a cliff, and you notice the interest rate went to effectively zero for quite a while. Then it started rapidly climbing. Well, it was climbing in response to inflation. What we've seen with inflation was kind of hanging around. It was in the twos, kind of where we expected it to be, and then you saw it spike. Also, when we talk about inflation, I like to point out there's two different charts here. One is the consumer price index for everything. This is all foods for urban consumers. Another one is less food and energy. Personally, I don't like the one less food and energy. I like to look at the blue chart because that's a more accurate measure of what we're feeling on the day to day when we're talking about inflation. But you notice inflation spiked, and as a response to that, federal interest rates went up. And then you've seen them drop. And then they've held steady the last two cycles, but we're anticipating, and the Feds are making the indication that they're going to be continuing to drop those rate cuts back down. So where we're sitting today is a federal funds rate is between 3.5 and 3.75. Okay. Powell came out and said yesterday's meeting, second consecutive hold. But the Fed's own projections are still pointing towards it moving lower over time. And the key insight here is that the markets move before the Fed does. We've already seen it inside of savings rates. If you notice, this just came straight off of NerdWallet. Here's some of the best high yield online savings accounts you can get. You're seeing 3.7, 3.2, 3.2, as much as 4.1. Well, that's dependent on how much you have in the account. You're seeing 3.8, 4.09, 4%. These aren't the fives and 5.5s we were seeing before. And then a lot of these rates, there's some restrictions around it. There's a certain time period around it. Notice it says earn up to 4.1 for 6 months on balances. Why is it time bound? Because they're anticipating it continuing to drop. Now, you also see the same thing hold true for standout CDs. CD rates are telling a very similar story. The best rates today we're seeing are the 4.1, 4%, 3.75, or 4.05. CD rates are continuing to drop. So if you're in a situation where you've been recycling CDs, 3-month CDs, 6-month CDs, and you've just been continuing to let them come due, throw it into another one, we're seeing those rates starting to fall. So the question is, if these rates continue to drift lower, are you wanting to reset them every few months, or does locking in stability make sense right now? So there's really three things that I think are worth addressing when we're looking at what's going on with the federal funds rate. The first one is a fixed rate, kind of a locked in strategy. Instead of going with a shorter term and watching it continue to decline every time that term comes due, go with a longer lock in strategy. The benefit here is you're going to have more predictability. So you know what your money is going to earn over that time period. It's going to protect against those declined interest rates, and it's best for assets that aren't needed in the short term. So the thing is, if you're putting it in and you're getting that term for 3 years or 4 years, that's a value add, but it's probably not something you want to use for assets that you need in the next 6 months. Now, the second option is you could go with an indexed account. I like to highlight how an indexed account works because they're pretty neat. And there's some confusion around them. But when you look at an indexed account, that's something that's looking at the stock market. So it's generating returns based off of the stock market. This is something like right here. You see the stock market's going to do one of three things. It's either going to stay flat, it's going to go up, or it's going to go down. If you have a situation where it goes up, there's cap rates. So it's looking at the stock market on your anniversary date, and then it looks at it again on your anniversary date. And it might have, say, a 9% cap. Well, that means If the S&P 500 is up 7, you make 7. If it's up 9, you make 9. If it's up 11, you make 9. On the other hand, because it's either going to go positive or it's going to be neutral, you're not going to lose anything. You don't have to worry about any losses. So if we incur a 20% drop in the market, well, the money that you started with, you're still going to have that at the end of that time period. And then it resets. So maybe the market has a slight recovery, but it doesn't make it back where it started. Well, because you're looking at it anew, you have the opportunity to get some of that gain. Again, up to the cap. Right now, that cap being 9%. The other option is you could use a fixed option. And the fixed account right now is currently paying 8% in that first year. Now, it does drop after that first year, but this is a way of locking in a guaranteed 8% rate of return over the next 12 months. It's something to consider, particularly if you're okay with having this sit in for a longer time period. Now, the third option is around dividend investing. I really like dividend paying stocks because it's kind of like owning a rental property, but it's inside the stock market. You buy that stock, it's kicking off dividends. You're collecting those dividends. Maybe you reinvest. Maybe you decide you're going to live off of that income stream. But even though the stock price may be going up and down, those dividends are much more consistent. Kind of like with your rental property, you're not going to check Zillow every day and see what's going on with the stock price. You probably don't want to check your stocks every day and see what's going on with their stock price. You want to be aware of what's going on. You want to buy your rental property in a neighborhood that you feel is going to do well and is going to appreciate. But those day-to-day changes are a little less meaningful than the larger trend, especially if you have good tenants that are paying you rental income along the way. It's the same thing with your dividend paying stocks. If you have stocks that are paying you that consistent 4.5% yield, it's a little less of a concern what's going on with the stock market on that day-to-day basis. Now, again, this can work really well during periods of market volatility. We've actually seen this year. Dividend paying stocks have taken a nice big boost because people are shifting away from tech and more disrupted areas because of the inflation impacts, but also due to the volatility that we're seeing from what's going on in the Middle East. But the bottom line here is you've got different options. And if you're in a situation where you have a lot of money that's been sitting in CDs, money market accounts, maybe some high yield savings accounts, and you've been watching it trickle down, you may realize you're kind of working against the clock here. So I would argue that as those rates continue to move lower, those yields are going to continue to decline as well. That's what happens automatically. So this is a real window to potentially lock in some stability, especially with some of these high cap rates that are available right now, because they are going to shift and go away over time. So for our existing clients, if this is something that kind of piques your interest, you're welcome to call in, talk with your advisor, explore some different options. For those of you that aren't clients, if that's something that you're interested in, and you say, hey, I want a little bit more information or see how this might work for my situation, you're welcome to schedule a discovery call with one of our advisors. And our goal here is just to help you protect and grow your wealth through whatever the markets throw at you, whatever happens with the environments that are out there. So thank you so much for watching. I hope you enjoyed this. I enjoy putting these kinds of things together. And if you want to know a little bit more about how interest rates are correlated with inflation and go deeper, I did a phenomenal presentation with Dr. Dalton. He's a professor of economics at Wake Forest, and we had a great conversation for an hour talking macroeconomics, microeconomics. But I hope this little segment helps you have a good, clear understanding of what's going on with the Fed rates and how that directly affects your wallet and your pocket with CDs, savings rates, money market funds, and things of that nature. For all of us here at Semmax, thanks so much for watching, and I hope you have a wonderful day.